Welcome. I'm live today to discuss a very important topic. It's a volatile week and month, and I wanted to have a quick chat with you guys and talk about the three tips which I want to share with you in this video, in a live stream, to how to trade or invest in volatile market. If you are able to hear me and able to also hear me loud enough and can see me, please type yes, so that whether it's on Facebook or YouTube, wherever you're seeing me live, I just type in yes, so I know that you're able to hear me and we can get started. So we're going to cover very important points today, and that's going to definitely help you in your journey, and it's going to be very short to the point. Three tips how to trade the volatile markets. Last week has been a crazy week where we have seen all the volatility, and especially with the Netflix, what we heard about it. So there's a lot of discussions going on. I thought, let me come in and talk about that. So we'll start a minute, and let me check if I'm able to get started. I think so the I will share my screen and we can go through quickly, uh, one by one, those points. First of all, welcome to Peaceful Weekend Investing. My name is Shivendra Bhatia, and I'm helping, becoming a retail investor, becoming a pro investors in stock market through my Peaceful Weekend Investing community. And I would appreciate if you're joining me live first time, do like, subscribe, and hit the notification bell if wherever you're joining in, and we can, get started with the show now. So let's go with the first point: is three simple tips to trade volatile market. What do we mean by that? Because some of you guys might be um, investors, some of you traders. I think at some point there's a lot of kind of an confusion. Some people who are investor become a trader, some people who are trader become investor. I think at the end of it, I kind of don't mix, I would say, don't highly differentiate between trading and investing per se, because I'm not a day trader, neither I am investing for scalping or 3-day swing trader. I do it for long term investing slash trading, whatever we want to call it, and I can share you some examples there, right? So the idea is, if you are a trader, you're going to benefit from this. If you're an investor, you will super benefit from this. So stay till the end and I will cover some important points. Okay, so if you look at it, first we start with very simple learning from Mr. Warren Buffett, a great world's greatest investor, and see what Warren Buffett has told us. And then we'll try to see that and implement that in a in a proper way, because everybody deciphers quotes in their way and try to implement it, right? And everyone would have a different learning, sometimes different, and different view to that particular sentence which was shared by some experienced investor, and we have to take cognizance of that. The true investor welcomes volatility, and widely fluctuating market means that irrationally low prices will periodically be attached to solid businesses. Now, this is so true, and we say give me red, and you would have seen my tweet about it, because volatility is an amazing friend for a long term investor. And volatility can be really a double-edged sword if you are trying to mix trading and investing, and that's why I'm coming live to talk about that, right? So you can keep your questions coming in on the chat and I can pick up at the end. So let's keep going on this. First tip I have is, don't sell your gems in panic button. And what do you mean by that? Most I've seen a lot of investors or traders, they tend to, as soon as they see there's a nosedive in, like what happened on Friday in Dow Jones index, that it nosedive, and there was a, you know s- if there was certain fall in uh, the prices, you tend to simply put the sell button. Never do that. Let If you think you have got into the wrong stocks, you let you know Let this first settle down and then try and exit in when you think is the right opportunity if you got into wrong stock. Okay, so and don't try to mix trading and investing, and you have to have a clear demarcation in your portfolio mix. And we in peaceful weekend investing call it peaceful weekend investing long term portfolio and peaceful weekend investing lab portfolio. Lab is where you basically still understanding the company, researching and trying to understand whether that can be qualified for long term portfolio. So you have to consider that very clearly and then work towards, and don't try to mix them up. So that's the first step. And don't just try to sell just because you're in panic state. Close your window, close, don't look at the trading screen, and just go for a nice walk. And when the market is closed, there's green tickers are not moving up and down, you can come back and make the right decision. Hope you finding it, this is a great tip, so please do follow that, and that will really help to make sure you don't just sell your uh, great stocks. Now let's go to the simple example. When somebody buys a particular stock, right, basically you're kind of sowing a seed, and after the seed will start giving some, it started giving some, coming to life, and small, it start flirting, and you'll see a small kind of formation there above the ground, and then suddenly it becomes a big tree which will start giving you regular cash through dividends, or it could be capital appreciation. So you have to look at it from that angle, and then if you are a long term investor, this probably might help. But if you're a trader, then you obviously have to follow you have to follow your stop losses and move out quickly. So you need to know what exactly happens. And here's one simple example what exactly people do. Let's say, for example, if you have a company A, and you basically losing 20% of it, and you got company B where you have gaining 120% out of that, and then you have company C 80%, company D 50% loss, and you have got company E which is you have 2000% gain, and company F which is you have 80% loss. If you're having this portfolio, overall returns will be great, because if you have the right allocations, provided that you don't have a very small, minuscule investment in company E where you're making most of your bucks, right? I'm assuming they're same, right? So your portfolio will be balanced towards company E, because that's where you have most allocation from the market value point of view. But most of the investors, what they end up doing, because they see these negative percentage losses where they have not exited at the right time, and they come out as a sore thumb for them, and they just keep on focusing on it, because our brains are wired to be in the negative zone, not look at the positive side of it. And what we end up doing, and is that if you want to rebalance in that situation, is you basically sell those big trees which can further go up, which I showed you earlier, and you end up doing averaging down on your loss making positions. And that is the most uh, that is most people do, and that's something the worst thing you can do. Rather, you should take the bite the bullet. If you think that if some company D has gone down 50%, if you add again, there's chances are that you might lose another 50%. And for it to recover your capital loss, it has to come 100%. So that way you don't want to do that and just sell off in every bounce. And you try and make sure you retain your big trees which you have in your portfolio, which can further compound your money. Okay, so that's one message I want to give you, so that you're clear. Don't do this. This is one of the biggest mistake which most investors do. Moving on, and again, that is like chopping off the tree from the top, right? If you do that. Second is, you have to remember and make a note of why you bought any stock. Sometimes people are just randomly buying stocks based on tips, fundamentals, or they could do their own fundamental study, or they're just technical reasons, or they could have heard from media and friends, and they just bought onto it. You have to remember that, because first of all, you can't borrow the conviction. You have to build your own conviction. And when you have a conviction, you will sail through all the volatility and probably make advantage position to that when volatility comes in. But if you are buying for technical reasons and you have a strict stop loss, don't just forget about it. Make a note of it and exit as per appropriate, uh, you know uh, the levels which you have decided at that moment. And and in short, probably you want to just make a note in your diary or scribble it or put it in trading journal, but that is the most important thing. And you not end up with those kind of weeds in your portfolio which are gone down drastically and you sold all of your gems, so called the trees, flower bearing trees. Okay, so make sure you remember that, and once the volatility subsides, you can also make the decision to make whether you want to exit or enter or average up or whatever you want to make the decision. But again, I have given a disclaimer. I'm just sharing you some of my learnings and experience. Please do consult your financial advisor before you make any decision. Okay, do give a video a thumbs up, and like button wherever you're joining from, so that way at least I know that you're liking our content. And then let's move on to third and last point: avoid media magnification. What do I mean by that? As you see, when this situation comes in, right, when this situation comes in, most of the media houses will start giving you big headlines, whether you're paper media, print media, or digital media, or on TV channels. And that is where the biggest problem comes in, and that creates those kind of nerve-wracking moment where you tend to make some actions and all your objective thinking takes a backstay. So media, and you have seen that, and I can like I can share just in a bit, where every tide, every let me share my screen so that way. So let's look at this, and let's take this 3-month chart of McDonald's. Now, this is a chart from 1969 for and logarithmic chart. Okay, so I've turned the logarithmic on so that you can see it properly, because log charts basically scales the price rise in same proportion and not magnify the recent price hike based on the change in price. So that way you get to see the real um, thing. As you can see here, marked there, ever since from 1969, stock has been unilaterally moving upwards regardless of what has happened to stock market. Now it's only one time, it is only 2003, where it went below this moving average of 50-month, and the blue line is moving average of 21 months, and 21 months being a Fibonacci number, that's why I've used 21 months, but you can use any month you want. But as you can see here, month on quarter on quarter, this is 3 months, so one candle is one quarter. And you can see here, it's only this period is where you had a downfall, and that downfall was pretty much significant. But from the term is 70% from the top, 75% from the top. And since then, the stock has gone one way rally, and it has only given 1600%, close to 1700% thereafter. So point I'm trying to make here is that if you are an investor and if you have those gems, you please do make sure that you look at this bigger picture before you exiting any stocks. And if you're a trader, you follow your stop losses clearly. And that's what it is. Regardless of it, media can create a lot of hype and a lot of things. So you just have to ensure you are uh, avoiding that. So this is one of the important points I want to share with you, and I have um, you know shared with you earlier this. There's a video which I released recently on Netflix, and also there is something, should you copy from famous investors. I think if you can further listen to these ones, you will definitely gain a lot of value out of that, because Netflix is just one example. Baba or the Alibaba is what's one example. It just keeps happening again and again. We have to ensure that we are following the process and we are doing an objective decision and don't just simply jump in, because Netflix has crashed 32% 35% just last week, but it has been going down for the last several months and has been down close to 75%. But I've explained that details in this video, so watch that out. So I'm going to sign off there. I don't want to make it big, but thank you. Namaste. See you next time. And if before I sign off and let you enjoy your Sunday, you please like, share, and comment, and connect me with me in any of these social media channel by the link sbhatia.co/bio, and subscribe to my channel, and look forward to meeting you again. Till the next video, I want to say goodbye to you.